All right, Brew Crew, welcome back to another episode of the Trade Update. Let's talk about Apple. I know we have other positions on, but I just want to take a look at Apple today and focus on that because I got a couple questions after yesterday's video as well as in the chat. So I figured I could touch on some important points. Let's go back to yesterday when I entered this Apple position. One thing that I failed to mention was why I got into the trade with the structure that I did on Apple with the 530-560 1/2 call ratio, and then why I did the subsequent adjustment. The reason was simply that I had a bullish bias on Apple, and my bias was that throughout this week, Apple would migrate higher to around the round number 550, maybe a bit further with the momentum it had from last Friday. But it wouldn't go too high to say like 600. So I wanted to put on something that could capture a move there, which would yield some handsome profits if that were to happen. Now, having said that, having that bias, there were many ways I could have structured a trade to reflect that bias. But let me just talk about a few of them to illustrate my point. The first way is I could buy the 530 call outright for this week. That'll cost me, back on Monday at the time I entered my trade in Apple, it'll cost me about $7.85 of debit. And Apple would need to go $7.85 beyond 530 for me to break even by expiration. I don't like this obviously because it's too much of a debit on entry. If I'm wrong and Apple tanks, I'll have to manage it somehow, and it's going to be pretty hard to manage it because of the high premium decay and delta risk. Second option, and a higher probability trade, would be if I make the initial entry by buying the 530 and selling the 560, hence creating a vertical, and that would cost $7.85 minus $3.70 or $4.15. So slightly cheaper, and I cap my max gain now because now the maximum value of this 30-point wide vertical is obviously $30, so I can at most make a profit of $25.85 if Apple just moons beyond 560. But I'm cheaper than that, I don't want to pay $4.15, right, for this vertical. And honestly, the whole move up is kind of a moonshot. So the third option, a more enticing structure, the one that I ended up doing, would be something like a ratio spread, which consists of a long unit of the 530 call and multiple short units of the 560 calls. It can be any ratio, doesn't have to be a 1/2, it could be a 1/3, a 2/3, an X by Y ratio where Y is greater than X, basically where you have more extra further out of the money short calls than you do long calls. And the idea here is that the credit from the short calls would offset the total debit of the rest of the long calls. So in the 1/2 that I did, the two 560 calls that I sold and got a credit for offsets the debit of the long 530 call. So this structure right there costed a total of 40-cent debit when I got in, which is already much less than the 530-560 call vertical outright, and of course way less than the naked long call by itself. So you could see with my choice, if Apple tanks or goes sideways and does nothing, then I lose a smaller debit than I would have if I, had chosen to go with the first two structures that I talked about, because my debit is 40 cents compared to, $4.15 or even worse, $7.85. However, because I'm now short an extra call naked, I theoretically have unlimited upside risk, right? If Apple moves too far to the upside and runs over that 560 call, then that call is going to begin to offset any gains made from the 530-560 long vertical, because the max value of the 530-560 vertical is capped to $30. If Apple just keeps charging higher beyond a certain point, that vertical spread is capped and won't increase in value anymore, but the naked short call is going to continue to increase in value and hurt me. So by utilizing a ratio spread, I'm actually trading a lower debit on entry with potentially unlimited upside risk. Now that I've covered why I entered with the initial call ratio, I need to talk about the adjustment that I did, which rolled one of the 560 calls down to 550. And I did this simply because at the time, towards the end of the day on Monday, I felt that Apple may not be as strong as I thought and may not go much higher beyond 560 by the end of the week. And I also wanted to collect as much credit as I can while it's still early on in the week and make sure that this entire trade did not cost me a debit in case Apple tanks. And so I did that and collected a 51-cent credit for doing so, which means now my credit on the entire trade is 11 cents, and my position now is this 530-550 call vertical plus a naked short 560. And as I mentioned in yesterday's video, the break even on this trade is now at 580 because I have 20 points of coverage from the 530-550 long call vertical that can help me offset a 20-point loss on the naked short 560 call. So now the question that gets asked a lot is, why in the world would I take unlimited upside risk? That just sounds terrible. How could I possibly know Apple isn't going to go to 1,000 by the end of this week? Well, I don't know if Apple is going to 1,000 by this Friday. No one does, but here's my thought process on why I'm okay with this theoretically unlimited upside risk. Okay, let's say Apple does spend some time moving up over the span of this week to 560, where most people would begin to panic because that's where the short call is. Let's just say by tomorrow it does that, it goes to 560. This means that my 530, 550 call vertical is pretty much in the money, and Apple is right at 560, which means that the 560 short call is right at the money. My question to you is, what would my spread trade for in that situation? Do we know? Without pulling up the risk graph, can we approximate what this spread is going to trade for? And the answer is yes, we can, just by looking at the options chain. This is my current position. Just ignore the other open positions where I sold more spreads and just focus on the 530, 550, 560 structure that I have. If Apple's at 560, where my naked short call is, and I have a 20-point wide vertical 10 points below that, then all I have to do is take where Apple is trading now, imagine that my entire spread is shifted down such that my short call is where Apple is trading now, and just sum up the value of this imaginary spread, and that will roughly be what my real spread would be trading for back up there if Apple moved to my actual naked short at 560. So looking at Apple right now, it's trading at $500-ish. So in my imaginary scenario, I'd be naked short the 500 call and I'd be long the 470, 490 call vertical. What is this spread trading for? We'll just take roughly the middle of each of these legs, so about 30 minus $14 minus 855, or about 745. My spread transposed down here such that the short call is at the money is trading for $7.45 currently. So if I just transpose this imaginary spread back up to where I actually have my current spread, then it's the same as if Apple moves up from where it is now to my actual naked short call up at 560. Basically, I can approximate that if Apple reaches my real short call right now, that my real spread is worth $7.45. Does that make sense? If not, feel free to rewind. Okay, now remember my spread. I took an 11-cent credit after adjustments, and right now, if Apple magically went to 560, ignoring volatility expansion, we know that my spread would be worth about $7.45, which means I can sell it back out at $7.45. So knowing that, why should I be worried about Apple going up to my naked short call? I shouldn't need to worry. Actually, I should be happy. I should be hoping that it does, because the spread is going to expand in my favor first before going against me. Don't you think I'd be happy getting paid 11 cents to make $7.45 more? For sure I'd be happy. I'd be like, yeah, keep it coming, J-Pal. Don't you dare turn off that printer, you know? And the other thing too is that $7.45 if Apple reaches the naked short call now. Think about tomorrow or the day after, when there's going to be more premium decay simply from time passing. So if Apple actually gets to 560 by that time, then the 530 long call is basically going to be deep in the money and going to retain its premium better than the short calls. So this spread is going to expand even more. It'll probably be worth like 10 to 15 bucks or something. And I got paid 11 cents to put on this whole spread considering adjustments. So yeah, I think, getting paid 11 cents to have no downside risk and the potential to make 10 to 15 bucks before really running into any true upside risk, I think it's a great trade. Right? What do you think? Would you want to get paid 11 cents to have no downside risk and the potential to make just 10 bucks, even though theoretically you have unlimited upside risk, but in reality you don't unless Apple gaps up, let's say 50 points tomorrow, or you just go to the prayer room and don't manage your trade? Let me know in the comments below. And here's another beautiful thing. Apple doesn't even need to make it that high to 560 for the spread to expand in my favor. Say by Friday, it only gets near the 530 long call. Well, the 550 short call and the 560 short call is basically going to be trading for zero, right? Because it's so far out of the money and there's not a lot of time left. But the 530 call will be trading for probably like $5 or so because it's at the money and still has a lot of extrinsic value left in it. So that's still a decent gain from an 11-cent credit versus, if you had just bought the 530 call outright for $7 or whatever, you would still be down on the trade. So that's another thing to think about. The interplay of the Greeks, time and direction, especially on the weeklies, is truly a beautiful thing. And over time, with enough experience, once you see things like this play out more in real time in the markets, you'll naturally develop the feel for this so-called ebb and flow of the Greek components. Now, understand that this isn't a glitch with the options prices. Don't go out there blindly putting on ratio spreads on weeklies and think you found the holy grail and you can immediately be profitable. The reason why the spread already has almost no real upside risk is that enough time has passed since I entered this trade that drained the value of the short calls. Early on in Monday when I entered, the premium was still pretty high, so The far out of the money calls were still trading for a very juiced up value. But after Apple traded sideways for the rest of Monday and pretty much all of today, those premiums on the shorts got crushed, while the long call retained its value better. So the spread expanded a bit, so that's why I'm basically profitable right now. And if we were to travel all the way up back to, 560, I'd be even more profitable. I wouldn't be profitable if Apple soared to 560 right after I entered on Monday, because then the short calls will remain extremely juiced up and the spread would contract and go against me. When you're playing these ratios, you almost want the stock to not go too hard in your favor first. You want it to kind of slowly meander its way up or just trade sideways early on in the week and then rocket up. It's one of those spreads where you want the stock to work its way up gradually, but not too fast, okay? So just know that you're not going to be profitable on entry. This isn't some magical spread. After your entry, you only will be profitable once the short call drains in value, the long call increases in value, or a combination of both. And that will happen if the underlying just crawls slowly upwards or hangs out sideways and then later on in the week shoots up. Anyway, this video is getting a bit long, but I hope that was somewhat inspiring and educational. Again, this option stuff is powerful if you know how to use it, from strategies to approximating spread values. The veterans know this, and if you know this along with good risk management, you can really create the equity curve that you're looking for that suits your own trading style, your own personality, and ultimately your own portfolio. See, options is more than just, buying naked calls or naked puts and dealing with wild swings up and down. And it's also more than just pure premium selling. It's it really can be however you want it to be. And for me, it's these types of trades. Sure, sometimes, they require adjustments and they might be more boring than the trades that they do in Wall Street bets, but I'm fine with that. If it's my own personality more, I'd rather put on these types of trades because it sits better with me. And I'm not saying you should be trading this way. All I'm trying to do here in this video is open your eyes to a bigger world out there so that you don't have to feel like you have to pay for some service that only spams alerts and plays and draws random lines on the charts, probably induces FOMO, and flashes only the winners. You don't have to feel like you're just blindly jumping in on trades and ending the day feeling like you just, walked out of a casino after throwing a bunch of stuff at the wall to see what sticks. These days, you can find setups anywhere for free. Come up with your own bias and structure your trade with options the way that you really are comfortable with, the way that suits your trading style, your risk tolerance, your personality, right? That's what personal finance is all about. And I know you know that options is much more than what's being presented out there these days. That's why you're here. That's why you subscribed and you hit that bell and you smash that like button and you shared this video with your close friends and family, because you guys want that valuable knowledge for the years to come. I know, especially now, because who knows if you're going to have your real job for much longer if you're trading all day instead of doing your damn work. Yeah, I know what you're doing. I see you. But don't worry, honestly, I don't know about myself either, especially if I keep making these videos for y'all. I'm just playing. Enough with the pep talk. But hey, for real, if you want to learn more, you know what to do. Join us by checking out the links to our Twitter, Discord, and Twitch down in the description below. It's all free. We share our thoughts, trades, setups, entries, exits, all that good stuff, all that good commentary, all those good vibes, all right? But for now, stay safe, Brew Crew, and we'll catch you in the next video. Cheers.